Welcome to Himalayan Stocks Gurukul, where we guide you towards long-term investment success with market stability.
On July 28, 2026, the Nifty 50 closed virtually unchanged, down a negligible 0.04%. But the headline index is a deception. While the index stood still, 2,048 individual stocks across the broader market were aggressively sold off. The stability you see is a mathematical side effect. Hindustan Unilever reported a 3% decline in quarterly profit, triggering a 7% capitulation that erased billions in market cap. That damage was only offset by an institutional rescue operation in large-cap IT, with TCS and Tech Mahindra propping up the weight of the benchmark. Beneath the surface, a 9,000 crore rupee liquidity war is in progress. Foreign institutional investors executed nearly 4,000 crores in net sales, while domestic institutional investors absorbed the shock with over 5,400 crores in net purchases. The crosscurrents are extreme. Larsen & Toubro just secured a 15,000 crore rupee infrastructure windfall in Europe, yet the India VIX has collapsed to 12.5, indicating a total absence of protective hedging. With the Federal Reserve policy decision looming and the Nifty pinned below its 200-day moving average, the market isn't drifting. It is executing a violent internal sector rotation. To navigate this transition, we need to analyze the specific positioning of global macro funds, mapping exactly where capital is exiting and where it is taking cover. The headline index is currently an engineered illusion. Survival in this market requires deconstructing these internal sector flows to find where the actual liquidity is moving. The Nifty 50 is trapped in a narrow 86-point intraday band. This is a time correction, staying flat while individual stock valuations are aggressively reset. Look at the internal breadth. On the NSE, only 938 stocks advanced against 2,048 declines, creating a negative 0.45 advanced decline ratio. Our market health score drops to 35. This signals exhausted retail liquidity across mid and small caps, leaving the market foundation structurally compromised. The most visible repricing occurred in FMCG. Hindustan Unilever's quarterly profit fell to 2,673 crore rupees, missing expectations and causing the stock to surrender nearly 7% of its value in a single session. HUL's collapse is a calculated structural repricing. High multiple defensive stocks are currently facing harsh rural volume contraction and margin compression. When premium valuations meet stagnant growth, institutional capital moves to exit. That capital is rotating directly into information technology. Large-cap tech stocks like TCS are seeing volume breakouts, acting as a hedge against broader market weakness. Macro managers are favoring IT because they perceive a bottoming of tech spending cycles in the US. In an environment defined by high domestic uncertainty, institutions prioritize sectors with visible, dollar-linked earnings. This is a textbook late-cycle defensive maneuver. Institutional capital is abandoning overextended cyclical sectors and moving into large-cap exporters that offer cash flow certainty. The data proves that holding defensive stocks trading at premium multiples without volume growth is now the highest risk in the market. The flat index is merely masking a ruthless valuation reset. To understand the velocity of this rotation, we have to look at the macro forces driving foreign and domestic liquidity. Foreign institutions sold nearly 3,900 crores ahead of the Fed's rate decision to avoid volatility, but domestic investors absorbed this with 5,400 crores in purchases, giving a liquidity score of 85. This domestic capital creates a floor, but foreign selling caps upside breakouts. Geopolitics is providing a critical tailwind. The diplomatic pause between the US and Iran has removed the immediate risk of a supply chain shock. This de-escalation pushed Brent crude toward the $86 per barrel mark, which is a vital threshold for the Indian economy. Sub-$90 crude acts as a massive disinflationary buffer. It directly protects the operational margins of aviation, paints, and logistics companies, supporting interest rate-sensitive pockets of the market. These macro conditions favor capital goods. Larsen & Toubro's 15,000 crore rupee offshore wind agreement demonstrates how engineering giants are securing international growth while domestic consumption slows. Unlike the FMCG sector, these heavy engineering firms have multi-year order books that are mathematically insulated from short-term shifts in rural consumer spending. The final global risk is the yen carry trade. If the Bank of Japan defends the yen, it triggers margin calls and a liquidity vacuum. While domestic SIP liquidity provides a visible floor, the macro fears of foreign investors mean the Nifty will likely remain trapped in a wide consolidation zone until global policy clarity emerges. These fundamental pressures are now clearly visible in the technical architecture of the major indices. The Nifty 50 is pinned. While it holds the 23,846 support level, it faces formidable resistance at 24,041. Critically, it is trading below its 200-day moving average, a zone of heavy overhead supply. Banknifty is even weaker. It is printing a bearish structure of lower highs and is testing critical structural support at 56,713. The primary derivatives indicator, the India VIX, has collapsed to 12.56. A VIX at these multi-month lows indicates an absolute absence of hedging panic. Because the market isn't pricing in volatility, option premiums have been crushed to exceptionally cheap levels. This lack of volatility allows market makers to execute a gamma pin. By strictly keeping the index near the 24,000 level, they force option buyers to suffer rapid time decay. With a MACD of just 11.5, the market has zero directional velocity. It is an environment where the index is designed to settle flat, regardless of intraday moves. This chart shows the risk. Buying naked directional options on dips is currently a mathematical trap. The pinning action at 24,000 ensures that theta decay will aggressively bleed your capital as you wait for a breakout that the data doesn't support. The current setup is engineered to harvest premium from retail traders. This environment mandates a shift away from directional bets toward market-neutral strategies. Aggregating these factors, the 85 liquidity score versus the 35 market health score, the quantitative model dictates a neutral outlook. The liquidity prevents a crash, but the poor breadth prevents a rally. Given the resistance at 24,041 and the support at 23,801, the optimal strategy for the expiry is a Nifty iron condor. Selling the 24,100 call and the 23,800 put allows you to harvest premium while the index remains pinned. This market transition requires a specific asset allocation framework, prioritizing structural stability over momentum. Exit overvalued consumer staples trading at premium multiples despite shrinking margins. Recycle that capital into large-cap IT and capital goods, offering a natural hedge against economic slowdowns. Finally, maintain a 10% allocation in physical gold. This acts as a non-correlated hedge against sudden geopolitical shifts or Federal Reserve policy errors. The deepest risk in the market right now is overpaying for domestic consumption narratives, while the broader market breadth is in decline. Index stagnation does not imply a lack of opportunity. The divergence between IT and FMCG reveals that alpha is currently found in relative value and sector-specific rotation. The flat Nifty masks dangerous internal distribution. Protect your capital by exiting consumption traps and aligning with sectors where institutional liquidity is flowing. If you want to track this rotation and see the data before the market moves, hit that subscribe button and ring the bell for Himalayan Stocks Guru Cool. We'll see you in the next trade.